Have you ever wondered how to thrive in any economic cycle? Changes in the economy can be daunting, but today, we'll unveil the ultimate strategy to overcome them. Forget about uncertainty because in this video, we'll show you how to successfully navigate economic ups and downs and ensure steady growth in your investment portfolio. We will explore an investment strategy that has proven to be one of the most solid and effective over time, regardless of prevailing economic conditions: value investing. In a world where financial markets can be volatile and hard to predict, value investing stands out as a strategy that focuses on the very essence of an investment, finding undervalued companies relative to their intrinsic value. Instead of following fleeting trends or momentary fads, value investing relies on in-depth and well-founded analysis of companies, focusing on financial metrics and evaluating whether a stock's price is lower than its true value. This means that value investing investors seek out companies in the market that are trading at prices they believe are significantly lower than their actual worth. The beauty of value investing lies in its adaptability to any economic environment. Whether it's a time of economic growth, recession, or stability, this strategy provides a solid framework for making informed investment decisions. What is value investing? It's an investment strategy based on the search and purchase of financial assets, such as stocks, that are considered undervalued relative to their intrinsic value. In other words, value investing investors look for opportunities in the market where they believe the price of an asset, like a stock, is lower than its true value, creating a margin of safety. This strategy focuses on the fundamental analysis of companies and financial assets to identify those with strong long-term growth potential. Suppose you're considering investing in a company called ABC Incorporated. Its shares are currently trading in the market at $50 per share. However, after conducting thorough fundamental analysis, you conclude that the true intrinsic value of ABC Incorporated shares is at least $70 per share. This means that, based on your calculations and assessment of the company's financial health, ABC Incorporated shares are undervalued by $20 per share. In this case, a value investing investor would see this discrepancy between the current market price, $50, and the estimated intrinsic value, $70, as an investment opportunity. They would buy ABC Incorporated shares at $50 with the expectation that, over time, the market will recognize their true value, and the share price will increase towards $70 or more. The key concept here is margin of safety. By purchasing shares below their estimated intrinsic value, value investing investors seek to protect themselves against market volatility and inherent investment risks. As the market adjusts and the share price approaches its intrinsic value, investors can enjoy long-term positive returns. Value investing is based on the philosophy of iconic investors like Warren Buffett and Benjamin Graham, who have successfully used this strategy for decades. This investment approach emphasizes patience, thorough research, and informed decision-making rather than following short-term market trends. This approach is based on the in-depth study of a company's fundamentals and its long-term prospects, rather than relying on short-term market fluctuations. Fundamental analysis involves a comprehensive evaluation of a company's financial statements, including the balance sheet, income statement, and cash flow statement. These documents offer a detailed insight into the company's financial health and resource management. Fundamental analysis also extends beyond the numbers. Value investing investors scrutinize the company's management team and their track record, as competent and ethical management can significantly influence the long-term success of the company. One of the central aspects of fundamental analysis is the estimation of future cash flows. Investors project the expected revenues, expenses, investments, and free cash flow of the company into the future. Based on these projections, they calculate the intrinsic value of the company, representing its fundamental worth. Why is it the best strategy for investing in any economic cycle? Imagine Michael, a hardworking man and a father of 2 children, who is concerned about securing a stable financial future for his family. Michael relates to many people who share the same concern about the economic ups and downs that can affect their lives. One day, Michael discovers an investment strategy called value investing. He starts researching and realizes that this strategy is based on solid and logical principles that can provide peace of mind during economic uncertainty. Michael notes that historically, value investing investors have consistently outperformed investors following more speculative market strategies over time. For example, according to studies, if you had invested $10,000 in Warren Buffett's investment fund in 1965, your investment would have grown to over $700,000 by 2020, while the overall market had a much lower performance. But how does value investing excel in any economic cycle? Michael discovers that this strategy has an inherent advantage. In times of economic crisis, such as a recession or financial crisis, uncertainty grips many people, including Michael. During these moments, value investing becomes an especially valuable approach for him and other investors looking to protect their wealth and make prudent financial decisions. One of the fundamental reasons why value investing shines in times of crisis is its focus on capital preservation. Instead of following the crowd and impulsively selling assets when markets are shaky, Michael adheres to a more thoughtful and well-founded approach. He uses fundamental analysis to identify undervalued quality stocks, which, being good companies, are not severely affected by the crisis and offer a margin of safety, meaning he acquires them at prices he considers significantly lower than their true intrinsic value. This margin of safety acts as a kind of financial cushion during times of crisis. When the market drops, stocks purchased with a margin of safety have higher resistance to losses. Michael feels more secure knowing that he is investing in companies that, according to his analysis, have a solid foundation even in challenging economic conditions. Furthermore, value investing promotes a long-term mindset. In times of crisis, most investors are dominated by fear and uncertainty, which can lead to hasty decisions and asset selling. However, Michael understands that economic crises are temporary events in the economic cycle, and long-term investments in solid companies are more likely to recover and thrive. The strategy also stands out for its ability to identify buying opportunities during crises. During these times, even shares of high-quality companies can drop to exceptionally low prices due to market volatility and investor panic. For Michael, this represents a unique opportunity to acquire stakes in solid companies at attractive prices. These investments can yield significant returns as the markets recover. Michael, as an investor following a value investing strategy, has invested in companies with a strong competitive advantage in their respective industries. As he faces an economic crisis, Michael notices that these investments maintain their stability and performance compared to more volatile investments. Michael observes that these companies have strong balance sheets and prudent financial management. They have an adequate amount of cash in reserve and manageable levels of debt. This allows them to withstand financial challenges that arise during an economic crisis without resorting to drastic measures such as mass layoffs or reduced investments. Michael realizes that companies with a competitive advantage tend to have a loyal customer base. This is due to the consistent quality of their products or services. During times of crisis, customers tend to maintain their loyalty, providing a more stable income stream compared to less competitive companies. During a recession, many weak companies may face difficulties and, in some cases, may even go bankrupt. Michael, having invested in companies with strong balance sheets and effective management, has more confidence that his investments will survive and thrive during the recovery. Value investing, through its solid principles and fundamental analysis, gives Michael the confidence that he can take control of his financial future and protect his family from economic uncertainties. It allows him to relate to the strategy, knowing that he doesn't need to be a finance expert to make intelligent investment decisions. If you've been seeking a reliable way to protect and grow your wealth, value investing offers a path based on solid principles and fundamental analysis. No matter what phase of the economic cycle we find ourselves in, this strategy can provide the peace of mind and financial security you seek for your future and your families. To learn more about smart investing, financial analysis, and proven strategies, make sure to subscribe to our channel and enable notifications. Here, you'll find valuable content that will help you make informed financial decisions and build a solid financial future. Don't miss out on our upcoming updates and join our community of committed investors. Together, we can achieve our financial goals and thrive in any economic environment. Thank you for being part of our channel, and we'll see you in the next video.